So, you're a foreign student, teacher, or researcher here in the US. Did you know there's a part of the tax code that's literally designed just for you? It's pretty complex, and honestly, a lot of people miss it. But it could save you thousands of dollars. Today, we're going to decode these tax treaties and show you exactly how to make them work for you. I want you to think of the US tax code like a series of locked gates. Now, for most international academics, there's this special set of keys called tax treaties that can swing those gates wide open to some serious savings. The trick is, you've got to know which key to use and when. So in this explainer, we're going to show you exactly how to unlock that code. All right, the very first gate you have to get through is your tax residency status. Now, this has nothing, and I mean nothing, to do with your visa or your passport. Nope, this is purely a tax definition. The IRS just needs to know how to categorize you. Are you a non-resident alien who only gets taxed on US income? Or are you a resident alien who gets taxed on your worldwide income just like a US citizen? Trust me, getting this part right is the foundation for absolutely everything else. So how do you figure out your residency? Well, it all starts with this one critical question. See, being an exempt individual is this special status that lets certain students and researchers avoid being classified as a US resident for tax purposes, at least for a little while. So what exactly does that mean? This is where the first really big benefit kicks in. Normally, the US uses something called the substantial presence test. It's basically just the IRS counting the number of days you're physically in the country to decide if you're a tax resident. But, and this is a huge but, as an exempt individual, your days literally don't count toward that test. It's a fantastic exception that keeps you in that non-resident category. But as you're about to see, it doesn't last forever. Yeah, this special status isn't permanent. There is a ticking clock. For students, you generally get to exclude your days for up to 5 calendar years. Pretty generous. For teachers and trainees, the rule is a little different. It's typically for 2 out of the last 6 years. But here's the catch. The second you cross that time limit, every single day you spend in the US starts counting. And that puts you on the fast track to becoming a resident alien for tax purposes, which, believe me, changes the whole game. Okay, so once you've sorted out your status, the next thing to look at is your income, because not all money is treated the same way in the eyes of the IRS. The type of income you get determines which key, or in this case, which tax form you need to use to unlock those treaty benefits. So this is probably the most important distinction you need to make. Just ask yourself, did you work for this money, or was it given to you for your studies with no strings attached? If it's wages for teaching or research, that's compensatory income. The key for that is Form 8233. If it's a scholarship or a fellowship grant, that's non-compensatory, and your key is Form W8BEN. You absolutely have to get this right. So let's talk about that first key, Form 8233. This is the one you give directly to your employer, like in the payroll department. You're basically handing it to them and saying, hey, a tax treaty exists between my country and the US, so please don't withhold taxes from my paycheck, at least up to the amount the treaty allows. It's a proactive move that keeps that money in your pocket from the very first paycheck. Now for that other key, Form W8BEN. This one is for your non-service income. So you'll give this to whoever is paying your scholarship or grant, most likely your university. It does a similar job. It certifies that you're a resident of a treaty country and that you're eligible for a reduced tax rate or even a zero rate on that grant money. Simple, right? 2 different income streams, 2 different keys. Okay, so you've figured out your status, you've handed over the right forms to the right people, but you're not done yet. There's one final crucial step. You have to officially claim these benefits when you file your US tax return. So how does that actually look? Let's make this super concrete with a real example from the IRS. Meet Jean, a student from France. He earned $8 grand. Now, because he filed that Form 8233, His W-2 from his job only shows $3,000 in taxable wages. So where's the other $5,000 that was exempt under the treaty? Well, that shows up on a totally different form called a 1042-S. See? The big takeaway here is you don't just pretend that exempt money doesn't exist. You have to account for it. And this is exactly how you report it. This is the blueprint, straight from your tax return. It's item L on Schedule OI, and it's basically your command center for claiming treaty benefits. You just fill in the blanks. Column A, your country, France. Column B, the specific treaty article number. Column C, how long you've used this benefit before. And finally, column D, the exact dollar amount you're claiming is exempt this year. It's a crystal clear statement to the IRS. Okay, we've nailed down the core process, but now we're getting into the master level. There are these hidden rules and weird little traps in the treaties that can really catch people by surprise, especially if you've been in the US for a few years. Let me introduce you to the saving clause. And honestly, this is the most important piece of fine print in almost every single tax treaty out there. What it says is that once the US considers you a resident for tax purposes, it saves its right to tax you just like any other resident. Basically, as if the treaty didn't exist. Yeah, it's a huge plot twist. So that leads to the million-dollar question, right? After all that work, understanding your benefits and jumping through all those hoops, do they just vanish the moment you cross that residency line? Does this savings clause just slam the door on everything? And here's the good news. The answer is not always. This is where you really have to dig into the fine print of your specific treaty. Most of them build exceptions right into the saving clause, often to protect people just like you, students and researchers. For instance, the US-China Treaty explicitly says that the benefits for students continue even after they become a US tax resident. It's like the treaty has a built-in protection against its own plot twist. Pretty cool, right? So look, here's the bottom line. The general rules give you the map, but it's the specific text of your country's treaty that provides the actual destination. And I can't stress this enough. Every single treaty is different. The only way to know for sure is to read it yourself. The IRS has them all online. Just go to irs.gov and search for United States Income Tax Treaties A to Z. Find yours, read it. That is how you go from just knowing the rules to truly mastering the code.